Hey, what's up, my friends? So welcome to the Ultimate Candlestick Patterns Trading course, right? So who is this course for? This course is for you if you're a forex trader, you're a stock trader, or even a cryptocurrency trader, because the examples, the strategies, the techniques, the principles, right, can be applied to these markets. And also, it doesn't matter whether you're a day trader, a 4-hour time frame trader, a daily time frame trader, because again, all this can be applied to the different time frames as well. So this is a very comprehensive trading course. I will put the timestamps somewhere on the screen so you can see which are the different sections and which are the timestamps, right, for each section. I also put it in the description, right, so you can refer to it easily and then hop around the trading course, right, if you wish to. But my suggestion is that if you're new to trading, I recommend you watch it from start to finish because the concepts, right, are built upon, right, one section on top of the other. And by the end of this course, my outcome that I hope for you is number 1, to be able to better time your entries and exits using candlestick patterns. Number 2, to help you identify when the trend is about to reverse so you don't get caught on the wrong side of the move, and also be able to predict market turning points. And finally, to equip you with a trading strategy so you can be able to profit in bull and bear markets. Sounds good? Then smash the thumbs up button and let's get started. When it comes to candlestick patterns, right, you will likely see one of two colors. Number 1 is what we call a green candle, a bullish candle. And the thing about candlestick patterns is that every single candlestick pattern has 4 data points. The opening price, the closing price, the high of the day, and this is the low of the day. So let's say, for example, you see this candlestick on a daily time frame. What does it mean? Very simple. This means, right, that over here at this point is the opening price of the day. This is the price where the market opened at. And this over here is the closing price of the day. This tells you that, let's say, the market closes at 5 p.m. At 5 p.m., this over here at this point is the closing price of the day. Now, what about this? This is the high. This is the high of the day, meaning during the day, right? What is the highest price point that the market went? So it's actually signified by this line over here. We call it the high of the day. Some people call it the upper wick, the upper shadow. That's fine as well. And then over here, clearly this will be the low of the day, the lowest price point that the market went during the day. So on the other hand, if you see a red candle, again, it has 4 data points, but where it is different is that the opening price now is above the closing price, whereas you look earlier, for a green candle, a bullish candle, the opening price is below the closing price. Okay, so again here, same thing. This is the high of the day if you are looking this on a daily time frame. This is the opening price of the day for a bearish candle. This is the closing price for the day for a bearish candle, and then this is the low of the day. Now, what if you don't see this on a daily time frame? What if you look at this chart or candlestick pattern on the 1-hour time frame? How do you interpret this? Again, same thing. If you see this on the 1-hour time frame, so let's say, for example, let's refer to the bear candle. Let's say the market opened here at 12 p.m. Okay, then this means, right, at this closing price, if you look at this on a 1-hour candle, this candle will be formed, right, at 1 p.m. Okay, this means that at 1 p.m. this candle will kind of like be formed and printed on your chart. Okay, and then the next candle will sort of, let's say, open somewhere here, and then next candle will start to, move up and down. And when the hour is up, then the candle will kind of like be finalized, right? So if you are looking this on the hourly time frame or the 15 minutes time frame, this is what it means, right? So again, just a quick recap. If you look at this, let's say one last time on the, let's say the 15 minutes time frame, let's say the market opened here at 12:15 p.m. Okay, what this means is that at the closing price at 12:30 p.m., the candle will close, it will be fixed and printed on the chart, and then the next candle will be open, right, and start moving up and down. So let's do a quick recap before we dive into the more advanced stuff. First thing, a candlestick pattern has 4 data points: the open, high, low, and close. A bull candle, this is where the close is above the opening price, and for a bear candle, this is where the close is below the opening price. Now that you've learned the basics of a candlestick pattern, in the next section, I want to teach you 9 powerful candlestick patterns that every trader must know. Now, the first candlestick pattern that you are going to learn right now is what we call a hammer. Okay, so what is the meaning of a hammer? So just a quick one, right? This is the opening price of a hammer. So if you look at this again on the daily time frame, this is the opening price of the day. This over here is the lowest price point that the market has went during the day. This is the highest price point the market has actually reached, right, during the day. And finally, the market closed at this price point during the day. So what does a hammer mean? What does it signify? So let me explain. So again, if you look at this on a daily time frame, this tells you that when the market opened, the sellers quickly took control and pushed the price lower down this extreme lows of the day. So during this point of maximum pessimism, right? The sellers, they were in control, driving the price down, really low. And then the buyers, they were pushed to a corner, right? Right at the wall, right? At their backs, right? Suddenly they found the strength. Maybe they took, some steroids. They gain control of their strength, their muscles, and they pushed the price up higher, okay? And eventually closing near the highs of the day. So you can see that during the early part of the day, the sellers were in control, driving the price down lower, but eventually, right, the buyers stepped in and pushed the price up higher, finally closing near the highs of the day. So this tells you that the buyers, they are temporarily in control, right? So this is what this candlestick pattern means. So it's a bullish reversal pattern. So for those of you who watch Avengers Endgame, right, you know that, towards the end, Captain America is left alone, right, facing Thanos' army, right? Okay? And at the point in time, it's the point of maximum pessimism. You think that, oh man, that guy is, he's dead, right? How is he going to find the army? And then what happens? His friend, I think Sam, the Birdman came in, the portal opened, Black Panther showed up, Wakanda forever! Right? And then what happened? The war ensues and the good guy win, right? So you can see the story is similar. The point of maximum pessimism, right? And then the reversal where the good guys overcome Thanos' army. So this candlestick pattern kind of like just reminds me of that story. So if you look at the chart, right, it will typically look something like this. This over here, again, is the hammer. You can see that over here, this reversal, the price opened at this price point. Then it went down to the extreme lows over here. Buyers took control, okay, and then finally closing near the highs of the day. Then the market did, had a slight brief rally up over here. And of course, we don't just trade hammer candlestick pattern in isolation. We take into account other factors like, support, market structure, etc. I'll cover all those stuff later on, but for now, I just want you to get familiarized, right, with this particular candlestick pattern. Now, on the other hand, right, shooting star, this is kind of like the inverse of a hammer candlestick pattern. So I'll just go a little bit quickly. For shooting star, this is the opening price. This is the close of the day. This is the lowest price point of the day. And then this is the highest price point of the day. So this one, you can see that the story behind a shooting star is just the opposite. This is where during the early part of the day, right, when the market opened, the buyers took control and pushed the price up higher near the highs of the day. And then the sellers, right, say, that's as far as you're going to go, my friend. And then they push the price down lower, driving it down near this lows of the day. So I do apologize for my wavy lines. I didn't really want that to happen, but it somehow just goes zoom like that, okay? So yeah, anyway, this tells you that the sellers, right, are temporarily in control because at the start of the day, the buyers tried to push the price up higher, but got overwhelmed by the strong selling pressure who then drive the price down lower, closing near the lows of the day. So this kind of reminds me, right, where you didn't study for an exam and you go for an exam and what happened is that you got back the report card. Man, you got an A despite not studying for the exam. And then it's only you kind of realize, oh, it's actually A for absent. And then your whole world come crashing down again, right? So yeah, same over here for this shooting star pattern. So if you look at the chart, typically it looks something like this on the chart. You can see over here, the price opened at this price point. Initially, the buyers were in control, pushing the price near the highs of the day. And then the sellers took control and pushed the price down lower, closing near the lows of the day over here. Next, we have what we call the bullish engulfing pattern. And by the way, if I have not talked about this thing over here, this is what we actually call a body. So from this over here to this, right, basically the colored portion of the candle, this is what we call the body. Okay, so from here to here, we call this the body. And then we have things like, shadow, tails. Let's keep things consistent, right? Let's call this the shadow, right? So basically from here to here is what we call the upper shadow. Right, Ninja Turtles, right? Shredder in the shadows, yeah? Or Turtles in the shadows. Yeah, so this over here, right, is what we call the lower shadow, right? So we have body and the shadow. Body is the one that is colored, right? Shadow is the kind of like just the candlestick, that shadow, that line sticking out. So now, what about the bullish engulfing pattern? What does this candlestick pattern mean? So earlier you've learned the hammer and a shooting star pattern. Those are individual reversal candlestick pattern. One candle formation. But for this one over here, you see there's two candle formation. You have this one is the first candle, this is the second candle. So for the first candle, you can see the opening price is here. And the sellers took control and drive the price down lower, closing near the lows of the day. That's what happened on the first day. Second day, what happened is that the market opened at this price point and the buyers pushed the price up higher, closing near the highs of the day. So there's this sudden turn of events, right, where the sellers on the first day, they thought they have won the battle, but only to see that the next day, the buyers step in and push the price up higher, closing near the highs of the day. So this is what we call a bullish engulfing pattern. Why is this? What does the word engulf mean? So engulf means basically to cover, to wrap around. So you can see that the engulfing pattern, the body of this second candle has engulfed the body of this first candle. So this is the body of the first candle from here to here, okay? And then the body of the second candle from here all the way up to here has engulfed the body of the first candle. So this is what we call a bullish engulfing pattern, wrap around, bullish engulfing pattern. And another thing to add is that so by right, so if you read most textbook and courses, right, by right, the definition of a bullish engulfing pattern is that the opening price of the second candle, right, it has to have a gap, right, from the low of the first candle. So by right, let me just show you what I mean. So most textbooks, what you'll see is that this is the low of the first candle, right? So by right, the opening price next day has to be somewhere about here, okay? And then the market eventually, push up higher, and then let's say close near the highs of the day over here. So you can see that the opening price is actually here, and this is the lows of the first day. So you can see from here to the opening price, there's what we call a gap, G-A-P, a gap. Okay, so this is the almost proper, but the textbook definition of a bullish engulfing pattern. But you can see that the example that I give you, there is no gap. I simply just left the open, right, at the same price as the previous day closing price. Why did I do that? And the reason is simple. Is because if you trade the forex market, you trade the crypto markets, it's traded almost 24 hours a day. You won't see gaps on your chart, rarely, right? So this is why I removed the gap portion, right, to kind of like make this more relatable for people who trade the crypto markets or the forex markets, right? But if you trade the stock markets, don't be surprised, right, where you see a bullish engulfing pattern. The opening price isn't here, but it could actually be slightly below the previous day low over here. It can actually open over here, right, and then finally push up higher and then closing near the highs of the day. So this is actually pretty common in the stock markets, but for the forex and the crypto, not quite as much. So just something to share with you. And if you look at the chart, the bullish engulfing pattern, right, looks something like this. First candle is a down day, market closed near the lows of the day, and the second day, the candle, right, closed higher for the day, closing near the highs of the day, and it has actually engulfed, right, the body of the first candle. Look at this first candle, and then this is the second candle, right? It has engulfed the body of the first candle. So this is what we call a bullish engulfing pattern. It means that the buyers, they are temporarily in control, and in this case, it did, went up a little bit higher. So the inverse is true, right? So this is what we call a bearish engulfing pattern. So the first candle is green, okay, and then you can see that the buyers, they are in control, closing near the highs of the day. And then the next candle, at this opening price, the seller drive the price down lower, closing near the lows of the day. This is what we call a bearish engulfing pattern. And it looks something like this on the chart. Okay, so you can see the price over here, buyers to control and drive into this area of resistance. And then what happened next is that we have a bearish engulfing pattern over here, where this body of this candle has engulfed the body of the first candle, closing near the lows of the day. And then what we have is like a decline down lower. So once again, right, we don't trade bearish engulfing pattern in isolation. We have to take into account the context of the market. So don't worry, later on I'll explain to you the strategy, the entries, the exits, examples, and much more. And by the way, if you're enjoying this training so far, smash the thumbs up button. If not, hit subscribe. So moving on, the next candlestick pattern is what we call a doji. Okay, so this again is the high of the day. This is the low of the day. And then this is over here is the opening price of the day. So now, quiz time. As I've said earlier, right, every candlestick pattern has 4 data points: the open, high, low, and close. But in this case, I've only shown you the open, high, and low. Where is the close? Take 5 seconds to think about this. 1, 2, 3, 4, 5. Okay, the answer is this. This over here is the close of the day. So a doji simply means that the opening price and the closing price, they are the same price point. So yeah, we still have 4 data points, just that the opening and the closing price is at the same price. So let's say they close at, the opening price is at $2, the closing price is also at $2. So this way, there is no body on this particular candlestick pattern. So what does a doji mean? So again, very simple, right? This is the opening price. It tells you that early part of the day, the buyers to control push the price up higher near the highs of this day, and then the sellers suddenly reverse the market down lower, taking control to these lows of the day. So this is the lows, this is the highs. And then eventually the buyers found the strength once again to push the price up higher, and finally they close pretty much where they opened for the day. So you can look at this, it's like indecision, right? Both the buyers and sellers, nobody is in control. So it's like, the girls, right? Man, you know, which guy should I go with? This guy is rich, this one is handsome, this one really loves me. I'm undecided. Who do I go with? You know? So yeah, there's a doji, undecided, right? So a doji is a neutral pattern, both buyers and sellers. Nobody, you know, has won the battle yet. So if you look at the chart, you can see that doji, this is a pretty neutral pattern. This is what we call a doji candlestick pattern. Now, moving on, right, there are many variations of a doji. So here are a few to share with you. This is what we call a dragonfly doji, okay? So let's find out where are the 4 data points. This over here is the opening price, and this is the low of the day. So now let me ask you, where is the closing price and the high of the day? As you know, every candlestick has 4 data points. So where is the high of the day and where is the closing price of the day? Let me give you 5 seconds. 1, 2, 3, 4, 5. Okay, answer is this. This is also the high of the day as well as the close of the day. So if you look at this dragonfly doji, the opening price, the closing price, and the high of the day is all at the same price level. Okay, so this is what we call a dragonfly doji. So why is this called a dragonfly doji? I have no idea. I can only speculate because people think that this looks like a dragonfly. Okay, maybe not, who cares? So anyway, so what is the meaning behind a dragonfly doji? So take another 5 seconds and think, right? What is the meaning behind this dragonfly doji? Does this look similar to a candlestick pattern that you have learned earlier? 5 seconds. 1, 2, 3, 4, 5. Okay, so if you say that it looks similar to a hammer candlestick pattern that you've seen earlier, then you're absolutely right. So a dragonfly doji has a similar meaning to a hammer. It's a bullish reversal pattern, although not quite as strong as a hammer, but I would say it still has a bullish meaning behind it. This is where the opening price over here, during the early part of the day, the sellers took control and pushed the price down lower near these lows of the day. And then the sellers, you know, they were back to a corner. I mean, the sellers were in control and the buyers got pushed to a corner until they say, that's enough, run. Let me come in, right? Come in, yeah. For those of you who watch Dragon Ball, right? So yeah, this is where the buyers push the market up higher, closing near the highs of the day, right? So they close at the highs of the day, which is also the opening price of the day, right? So this tells you that a reversal in market sentiment. Sellers were initially in control over here, and then the buyers reverse up higher, close back towards the high, towards the opening price of the day. So this is what we mean by a dragonfly doji. It's a bullish signal. So if you look at the chart, right, this is how a dragonfly doji looks like. Okay, so dragonfly doji opening price is here. Sellers were in control, pushing down towards the low of the day over here before the buyers finally step in and reverse back up, closing back where the market has opened earlier. So this is what we mean by a dragonfly doji. Okay, the inverse of the dragonfly doji is what we call the gravestone doji. So quick one, right? What candlestick pattern do you think the gravestone doji looks like? So if you learned earlier and you said a shooting star pattern, then you are absolutely right. It looks similar to a shooting star pattern. The difference is that for a gravestone doji, there is no body, whereas a shooting star pattern, you have this body over here. So a gravestone doji, similar to a shooting star, it has a bearish signal to it, where initially during the open of the day, the buyers were in control, pushed the price up higher, and then suddenly the sellers took control and drive the price down lower, closing near the lows of the day, which is also the opening price of the day, which is also the closing price of the day. So this is what we mean by a gravestone doji, signaling to you that the sellers, they are temporarily in control. So it looks something like this. Over here, you can spot the gravestone doji. Over here is the opening price. This is the low of the day as well as the closing price of the day. And this is the high of the day. So initially, buyers took control, push the price up higher, closing near the highs of the day. And then the sellers drive the market down lower, closing back towards the opening price of the day, and signaling to you, right, there is a rejection, right, of this higher prices over here. Okay, the next candlestick pattern that we have is what we call the morning star pattern. And I want to point out is that this particular candlestick pattern has 3 candles involved. This is the first candle, this is the second candle, and then this is the third candle. So this is a 3 candle reversal candlestick pattern, right? There are 3 candles involved. So what does the morning star pattern mean? So let's analyze this, right, bar by bar. So on the first bar, the first candle over here, you can see the market open over here, and the sellers took control and pushed the price down lower, closing near the lows of the day. So at this point, you can see that the sellers, man, they are winning the battle, right? Booyah, who's your daddy? So the sellers are clearly in control, driving down the market lower for the day. Then what happened next is that the next day, the market opened at this price point. So at this point, right, I think the sellers will think that, oh man, this today is going to be another bloodshed day, right? We're going to crush the market today as well. But what happened instead is that the market tried to rally up higher, right? Over here, then this is the highs of the day, and then only to reverse down lower, retesting the lows of this day, or rather testing the lows of the day, And then finally pushing up higher and closing, right, where it pretty much opened for the day, which is over here. So at this point, you can see that the sellers, they try to drive the price down further, but it's met by but there's a lack of selling pressure, right? Or there could possibly be strong buying pressure stepping in where the opening price and the closing price is the same for the day. So this candlestick pattern, the second day one, if you have seen the earlier training, you know that this is what we call a doji pattern. It's a neutral pattern where both the buyers and sellers, right, they are pretty much in equilibrium. Okay, so nobody's winning the war as of yet. And what happened on the third day is, very interestingly, on the third day, the market opened at this price point. They opened over here. Okay, and then the buyers suddenly found the strength and stepped in and pushed the price up higher. Kamehameha! All right, and they closed near the highs of the day. So if you look at this from this three candle perspective, the story goes something like this, right? On the first day, the sellers are in control. They drive the price down lower on the first day. The second day over here, the sellers tried to drive the price down lower but couldn't push it any lower. Instead, what it ended up is a doji, it's a neutral day where both the buyers and sellers are in control. And on the third day, the buyers suddenly stepped in and pushed the price up higher, closing near the highs of the day, reversing, right, the down move, right, from 2 days ago. So this is a bullish reversal candlestick pattern, right, the morning star, telling you that the buyers, right, they are temporarily in control. So if you look at the chart, it looks something like this. So you can see over here, right, for this particular example, the price came towards this area of support, right? So price came into this area of support. We had a bounce up higher and retest support. So over here, look at the second retest. This is where I want you to focus on. We had strong selling pressure, right, from this highs all the way down into this area of support over here. And then we have this particular morning star pattern which is shown over here. So let me explain to you the psychology of the market. So the market drive the price down lower. On this particular candle, you can see that the sellers, they are clearly in control. They might have thought, right, they have won the battle. Man, we have, broke below support. The market is going to collapse, going to go down lower, right? Who is your daddy? Right, then on the next day, we have this doji looking pattern. So when the market forms a doji looking pattern, it can be one of two scenarios. Number one, there's a lack of selling pressure, lack of, I can just call it SP, right? Selling pressure. Or number two, it could be strong buying pressure. Okay, so we have no idea which is which. If there's a lack of selling pressure, then you can see that the candle, the range is just not going down any lower because nobody's wanting to sell. At the same time, it could also be strong buying pressure because there could be very strong selling pressure trying to push the price down lower. But why it ends up as a doji is because there's also an equally strong buying pressure coming in, right, to hold up the price. So strong selling pressure meets strong buying pressure, you end up as a doji as well. So it could be one of these two scenarios. We do not know which is which unless we look at volume and then we can tell. But as of now, I have no volume on this chart, so we can't tell as of now. And then what happened is that on the third candle, we have this strong bullish reversal candle. I think we can even call this as a bullish engulfing pattern if you want, because it has engulfed the body of this this candle over here. Right, see, we have strong bullish candle closing near the highs of the day. So at this point, it tells you that the buyers, they are temporarily in control, because if you look at the story for this morning star, sellers push the price down lower, okay, couldn't push it any lower, form as a doji. The third day, buyers took control and pushed the price up higher, closing near the highs of the day. The move is pretty strong that even closed above, right, the highs, right, of this first candle over here. So at this point, this morning star shows you a bullish reversal pattern and that the buyers, they are temporarily in control. Next on the list is what we call the evening star pattern. So one thing to point out is that the evening star is similar to the engulfing pattern in the sense that if you read textbooks or courses, right, they will tell you that the morning and evening star, there should be a gap. But the reason why I didn't put a gap over here is again because if you trade the forex market, the crypto markets, you would rarely see gap on the charts. So if you look at textbook examples, it would probably look something like this. So the first candle would be something like this, okay. Then this second candle could be over here like this. And then the third candle, it comes down lower like this. Okay, so this is something that you might see in a textbook or other courses. So you can see over here, right, from here to here, right, is the gap. Okay, this is the gap that we have over here that you might see elsewhere. All right, but for me, I didn't put the gap over here because again, you trade the forex or the crypto markets, this is something that you will unlikely see on those markets. So I kind of like remove this to make it relevant for crypto and forex traders. And another thing to add also is that for the evening star and the morning star pattern, this one doesn't necessarily have to be a doji pattern, because it can also be a pattern like what we call just a small body candle, something like this. It could be something like this, right? A relatively small body candle like this, and then it reverses down lower over here, close like this. Right, this again could be also an evening star pattern. So there are slight variations to it, and I'm not going to cover all the variations, right, because later on, as you'll find out that, you don't really need to memorize every single candlestick pattern out there, because I'm going to share with you a cheat sheet, right, that within 5 seconds or less, right, you know whether the buyers or sellers are in control. So I'll talk about that later on. But for now, let's talk about the evening star in more detail. So again, the evening star is just the inverse of the morning star. The first candle, you can see that the buyers, they are in control. This is the opening price. They drive the price up higher and close near the highs of the day. Okay, so clearly at this point, right, the buyers, they're in control. And the next day, they thought that, oh man, let's drive the price up further, right? Let's push it up to the moon, And then what happened is that on the second day, the market formed a doji pattern. So this means that the market is pretty much neutral for the day. Both buyers and sellers, right, they're kind of like in equilibrium, right? This is the opening price of the doji. Price tried to go up higher, failed to do so, then come down lower, formed the low of the day, couldn't close near the lows of the day before it got rejected, and then close back at the same price where it opened. So both buyers and sellers, they are in equilibrium. What happened on the third day? Third day, the market opened at this price point, and then the sellers took control and drive the price down lower, and finally closing near the lows of the day. So this tells you that this particular candlestick pattern, the evening star, is kind of like a turn of event, right? Initially, the buyers were in control. They were bullish all the way up to the top. Then you find some pause in the market, right, that is dictated by the doji, and then suddenly there's a sudden reversal where the market come down lower, closing near the lows of the day. So this means there's the market is, or rather the sellers, they are temporarily in control, and the market could possibly head down lower. So looking at this chart, you can see over here, the market came towards this area of resistance. I'll talk more about later about support and resistance, what it means and how to draw it and stuff like that later on. But for now, I just want you to pay attention to the evening star pattern. Notice how the price drive up into this area of resistance, right, that is marked in red over here. So for those of you who are not familiar, resistance is an area where selling pressure could come in to push the price down lower. No guarantee you will reverse from resistance, so this is where you can use tools like candlestick patterns, right, to help you time your entry. Again, don't worry, right, we'll talk about all the details, the trading strategies, entries and exits later on. And where it got interesting is that over here we have this evening star pattern. Look at the first candle, how bullish it is. The buyers took control and pushed the price up higher, closing near the highs of the day, breaking out of resistance. People think that, oh man, this is the breakout, it's real, time to get long, buy. Then what happened is that on the second day, this candle over here, notice we have this doji looking candle over here. So this is not exactly a doji, because you can see that there's a pretty small body over here. So that's why I call it a doji looking pattern. The body is pretty small, but you can see that there's still a small body. And the message behind this is that, both the buyers and sellers, they're pretty much in equilibrium, because the opening price and the closing price is near the same level. Okay, this is the second candle over here. And then what happened next is on the third candle, the sellers took control, okay, and they drive the price down lower, closing right near the lows of the day. So this lows of the day, right, has take out the lows of the previous day and pretty much drive, more than halfway through of the body of the first candle over here, right? So closing somewhere around this portion right on the first day. So you can see that the sellers, they're now temporarily in control. And also one more thing about the evening star to add is that, according to most textbook definitions, the close of this third candle just has to exceed the halfway point of the first candle to be classified as a evening star pattern. So for example, if let's say this third candle, let's say it only closed somewhere over here, right? This won't be considered an evening star pattern because it only closed around the 25% mark of the first candle. So it has to exceed the 50% mark of the first candle. So let's say the first candle, the 50% mark, let's say it's somewhere about here, okay? About here, okay? So this means that the third candle has to close right beyond the 50% mark. So it has to close below this line. So in this case, it closed over here, which is below this line. So this is where the evening star pattern is kind of like concluded, right? We call this an evening star pattern. So again, this has a bearish annotation to it, and in this case the market has a slight dip down lower. So let's do a quick recap, right, to the things that you've just learned, right? A lot of candlestick patterns, right? Number one, we talk about the hammer and the shooting star pattern. So these are single individual reversal candlestick pattern. The hammer looks like this. It tells you that the buyers, they are temporarily in control, and the shooting star looks something like this, and it tells you that the sellers, they are temporarily in control. And another thing to add is that usually for hammer and shooting star, the length of the shadow, right, is usually at least 2 times the length of the body. Okay, so there's another thing to kind of take note of, right? So I repeat once again, the hammer and shooting star, usually the length of the shadow is at least 2 times the length of the body. Yeah. Next one, we have the bullish and bearish engulfing pattern. So bullish engulfing pattern is again a 2-bar reversal pattern. This over here is the first one, is a bearish candle, and then the next candle we have a strong close above the first candle. Okay, so this is what we call a bullish engulfing pattern, where the second candle over here has engulfed, right, cover the body of the first candle. So this is a bullish pattern. So the bearish engulfing pattern is just the opposite. It looks something like this, where the first candle we have a bullish candle, okay, and then the next candle, right, could be something like this, where it engulfed the body of the first candle and closed lower for the day. Okay, this is what we call the bearish engulfing pattern. Then moving on, we also talk about the doji, the gravestone doji, and the dragonfly doji. Doji is simple, right, just like this, like a cross. Gravestone doji is this one over here, and dragonfly doji is like this. Okay, so basically this has a bearish annotation to it, and this has a bullish annotation to it. Why is that? It's because over here you can see rejection of higher prices. At one point in time, the market opened at this price point, trade up to this highs, only to get rejected and come down lower and close where it opened for the day. So you can see that this over here, this entire portion is rejection of higher prices, and then this dragonfly doji is just the inverse. This entire portion here is rejection of lower prices, where the market closed at the same price where it opened previously. Yeah, and moving on, we talk about the morning star and the evening star. This is a 3-candle reversal candlestick pattern. The morning star is something like this, right? So morning star, I mean, if you think about this, how do I know whether morning or evening is bullish or bearish? Just think about it. Morning, the start of a bright new day. This, things are filled with hope and, a great day ahead. So we think about bullishness. Yeah, so morning star is something like this. Okay, so this is usually a down candle. Then we have a next candle where it closed more than 50% of the halfway mark of the first candle. So if the first candle, the halfway marks, let's say somewhere about here, this means that the third candle has to close above this halfway mark to be classified as a morning star. And the evening star is just the inverse, right? So this one over here, so first is a green candle, then we have like a doji, or maybe even just a small body candle, and then the market on the third candle close right below the halfway mark of the first candle. So this is what we call an evening star. So this has a bullish annotation to it, and this has a bearish annotation to it. At this point, you've learned a number of candlestick patterns, and here's the truth, is that there are many more other candlestick patterns out there. I think possibly 50 or hundreds more out there. And the reason why you don't need to learn every single one is because I'm about to share with you a cheat sheet such that you can understand any candlestick pattern in less than 5 seconds. Sounds good? Then let's get to it. Now, the first part of this candlestick cheat sheet is this, right? Number one, you want to ask yourself, where did the price close relative to the range? So what do I mean by this? As you know, right, every candle, they have a range, the range between the highs and the lows. So let's say this particular candle, let's say this is the body, okay? Then you know that this is the highs, and then this is the lows. At the same time, this is also the opening price, and then this is the closing price. So you want to ask yourself, where did the price close relative to the range? And then, of course, there are many ways this can happen. It can also happen like this. Okay, in this case, you can see over here with this upper shadow, and this is the highs, this is the open, this is the close, and this open, let's say this is the low. So in this case, where did the price close relative to the high? In this case, it closed, right, I would say near of pretty far away from the highs. So this tells you that there is not very bullish, not as bullish as this first candle over here. So you can see where the price closed relative to the range. Okay, so in this case, the range is from this highs to this lows, right? Can give you an insight to who is in control, whether the buyers are in control or the sellers are in control. So let me dive this a little bit deeper. So if you look at this chart over here, you can see that this is over here, the first candle. All right, the range of this entire candle is from this highs to this lows. So now ask yourself, where did this price close relative to the range? So you can see the market has closed at this price point over here. This is pretty near the highs. So this is why we say that this is a very bullish candle, because the price has closed near the highs of the day, assuming it's a daily time frame. Now what about this? The market is closed over here. So where did it close relative to the range? It closed, relatively near towards the highs, but of course not as high as this first candle over here. So overall, we can say that, yeah, this is still somewhat a bullish candle because the price is closed, right? Almost approaching near the highs of the day. Not very close to it, but, much nearer to the highs than the lows. Now, what about this candle over here? Why is this a least bullish candle? Because yes, even though the market has closed higher for the day, this is the opening price, this is the closing price, even though it has closed higher for the day, but it's actually very far away from this highs of the high of the day. So you can see that this portion over here is what we call a rejection of higher prices. So yeah, even though it closed higher for the day, there is some sense of a bullishness, but it's not very bullish. I'll consider this the least bullish among the three. So knowing where the candle closed, right, relative to the range, right, can give you an insight to whether the buyers are in control or the sellers are in control. So let's do a few more before we move on. So same for this one over here. The market opened at this price point and then closed near these lows over here. Why is this a bearish candle? Right, because you can see that yes, even though it closed lower for the day, it didn't manage to close at the extreme lows. It just closed somewhat near to the lows of the day. So we can consider this a bearish candle. Why is this very bearish? It's because the market opened over here and it closed right near the lows of the day, right? Almost near the low. So this is a very bearish candle. And then this is the least bearish is because again, you can see it opened over here. It closes over here. Yes, it's a down day. The market is closed lower for the day. But if you look at the close, right, compared to where it was, right, previously during the day, at one point, right, it was actually trading near these lows over here. And then the buyers did step in and push the price up higher and eventually causing the market to actually close somewhat below the opening price for the day. So yep, it is still bearish, but it's the least bearish among the other candles that we have just discussed. And again, right, this one over here, why is all this a neutral candle? A neutral candle over here is because again, the market is pretty much just close, right, within the middle of the range. Okay, you can see right, this is the highs, this is the lows. It closed flat in the middle of the range. So this is a neutral candle telling you that both the buyers and sellers, they are pretty much in equilibrium. Same for this one over here. This one, fun fact, this is what we call a long-legged doji. In other words, the difference between this first doji pattern and this one over here is that the volatility of this candle over here is greater than the volatility of this doji looking pattern. So this tells you there's more volatility in this particular market, right? That's why you can see that the swings are much wider, but the meaning behind it is still pretty much the same. The buyers and sellers, they are pretty much in equilibrium. And finally, what's this little negative sign over here? This is what we call a fall price doji. This is where the opening price, the highs, the lows, and the close of the day is pretty much at the same price point. And this is usually due to markets which are very illiquid, right? There's not much price movement. You get this type of neutral or rather fall price doji looking candle over here. Okay, so that's the first part, right? Knowing where did the market close relative to the range. And this is important because it tells you who's in control. And by the way, if you're enjoying this training so far, don't forget to smash the thumbs up button to bring a smile to my face, okay? Now, the second part of this cheat sheet, right, is this, right? What's the size of the candle compared to the earlier one? So the first part of the cheat sheet, right, just a quick recap, is to where did the price close relative to the range, is to find out who's in control. Are the buyers in control or the sellers in control, right? Because as you know, right, if the price closes near the highs of the range, clearly the buyers are in control. And if the price closes near the lows of the range, the sellers are in control. If it closes near the middle of the range, pretty much indecision, undecided. Now, what about this? What's the size of the candle compared to the earlier ones? This question, right, helps you to, question tells you, right, the conviction, right, behind the move. So let me explain what this means. So if you look at this chart over here, you can see that over here we have a pullback. Right, market goes up, pulls back, goes up, makes a pullback. And then over here we have this, what we call a bullish engulfing pattern, where the body of this candle has engulfed the body of this previous candle. But if you look at the size of this bullish engulfing pattern, it doesn't really give you much conviction behind the move, right? Because if you compare the size of this candle to the size of the earlier candles, like this one over here, this one over here, this one over here, maybe this one over here, it's pretty much similar size or maybe even slightly smaller, yeah? So where we want to pay attention or to find out whether there's any conviction behind the move is to pay attention to the size of the candlestick pattern, right, compared to the earlier one. So if you see an example like this, right, now you see a difference, right? Market makes a move up higher, it makes a pullback, slight move up higher and makes a pullback. And now we have this bullish engulfing pattern once again. But look at the difference between this bullish engulfing pattern and the earlier one. If you look at this bullish engulfing pattern, this one over here, and you compare it to the earlier candles like this, like this, like this, like this, like this, like this, you can see that it's much bigger than the earlier candle. So this tells you that there is conviction behind the move and the market is likely to head up higher. So this is what I mean by, comparing the size of the candle relative to the earlier ones. So just a quick recap with the cheat sheet. Number one, the first question to ask yourself is where did the price close relative to the range of the candle? This gives you an idea to who's in control, whether the buyers, sellers, or equilibrium. And then finally, what's the size of the candle, right, relative to the earlier ones? This tells you whether there's any conviction behind the move or not. Okay, so this kind of like sums up, right, the entire training on candlestick patterns. But what we are going to do next is to actually dive into the trading strategy, because as you've learned earlier, right, we don't just trade candlestick patterns in isolation. We don't just see, oh, Rainer, look, there's a hammer, buy. No, we don't do just that, right, because we still need to look at the market structure, the area of value, support, resistance, when to enter, when to exit, and much more. So all the juicy stuff coming up right now. Okay, the first part of this trading strategy is to learn the market structure, right? So once you learn market structure, you pretty much know what to do, right? Should you be a buyer? Should you be a seller? Or should you just stay out of the market? So when it comes to market structure, there are three market structure every trader should know. Number one is what we call the uptrend. Number two is a downtrend. And number three is a range market. So let me dive into this into more details. So uptrend, what is an uptrend? So a market is said to be in an uptrend when it consists of a series of higher highs and higher lows. Like for example, market heads up higher, makes a pullback, heads up higher, makes a pullback, higher, makes a pullback, heads up higher. So you can see over here we have a series of higher highs, let's call it HH, higher high, HH, and then with this higher low, okay? Why is this called a higher low? Is because, right, the low over here is higher than this previous low over here. And why is this called a higher low? Is because this low over here is higher than this previous low. Same thing, why is this called a higher high? Because this high is higher than this high over here. Does it make sense? So let's have a look at an example to see this in action. So if you look at this chart over here, this is what we call an uptrend, right? From left to right, market is heading up higher, an uptrend. If you look at the highs and lows, we have a series of higher high, a higher high, a higher high, higher high, higher high, and higher high. What about the lows? If you look at the lows, right, this would be the first higher low, right, because it's higher than this low, higher low. This is another higher low, another higher low, a higher low, a higher low, and a higher low. So you can see that when the market is in an uptrend, it will consistently form a series of higher highs and higher lows. Now, some of you might be thinking, but Rainer, this is not as easy as it seems, because there are times where I see the market is in an uptrend like this, then it goes down lower, and it continues up higher. So now, Rainer, let me ask you, Rainer, is this now in a downtrend because we now have a lower high and lower low? So that's a good question, right? Because in market structure, in an uptrend, you don't always get a series of higher highs and higher lows, because there are times where the market can make a pullback, and within the pullback, right, the market gets messy. It forms a lower high and lower low, like what you're seeing over here. Or sometimes it could even do like this over here. Market goes up higher, then it chops up into a range. You thought it's going to be a reversal, and then boom, it breaks out higher. So how do we know whether an uptrend is intact or not? So this is where I'm going to share with you. Pay attention, right? Something really important is what I call is this, right? Basically, an uptrend is invalidated only after the price breaks below the swing low that precedes the breakout. What do I mean by this? Okay, so let me give you an example. So if you look at an uptrend, okay, price goes up, comes down, goes up, comes down, goes up, comes down, goes up. So when we talk about the swing low that precedes the breakout, we are actually referring basically to a major swing point on the chart. Now, when I talk about major swing point, it can be hard to decide. Like for me, I know this is a major swing point, this is a major swing point, this is a major swing point. But to new traders, they can't tell. So how do we know that's a major swing point? Is that you want to look at where did the market broke out previously. So you can see over here, previously this was the breakout point, right? Over here, this is the highs, and the market broke out over here. So this is the breakout point. Now, where is the swing low that precedes the breakout? The word precedes means before. Where is the swing low that happened before the breakout? So you can see that the swing low that happened before the breakout is this swing low over here. So in other words, right, this uptrend will be intact unless the market has break and then close below this swing low. Until that has happened, right, we would say that the uptrend is still valid and we are expecting higher prices to come. Okay, we would say the uptrend is only invalidated if it breaks below the swing low that precedes the breakout. Okay, so let me give you an example. So if you look at this chart over here, let me ask you, quiz time. Okay, I'll just make your life a little bit easier. This over here, right, is the high, okay? And when the market breaks out of this high over here, right, you want to ask yourself, where is the swing low that precedes the breakout? And then you have this swing low over here, okay? Now, when you look at this chart, right, you can see that now the market has actually break and close below this swing low, right? Yes, break and close below it. So my question to you is this uptrend still intact or it has been invalidated. 5 seconds. All right, think about this. 1, 2, 3, 4, 5. Okay, so the answer is this, is that the uptrend is actually still intact because it did not break below the swing low that precedes the breakout. Okay, this uptrend is still intact. So you can see what happened next is that this market, it did dip down lower and then continue dip down lower and then continue up higher, because this is the swing low that you want to pay attention to. If only if the market breaks and closes below it, then we can say that, hey, this uptrend is no longer intact and the market could possibly go into a range or reverse down lower. So remember, right, uptrend is invalidated only after the price breaks below the swing low that precedes the breakout. Okay, so one more example. Look at this chart over here. At this point, the market has break below this low over here, has break and close below it. Let me ask you, is the uptrend still intact or has it been invalidated? Otherwise can be said that the uptrend is destroyed. Yeah. So what's your answer? 5 seconds. 1, 2, 3, 4, 5. Okay, the answer is this, right? So if you first and foremost find out where is the swing low that precedes the breakout, this is the breakout point. Right, this is the highs that we are referring to. So at this point, the market has break out of this highs. So where is the swing low that happened before the price breaks below this highs? This is the swing low over here. So at this point, you can see that the market did break below this swing low. So at this point, this is what I'll say, right, that the market, the trend is no longer intact and it could possibly, go into a range or even reverse down lower. Now, one important thing to add is that in an uptrend, we only want to look for buying opportunities. So for example, if you see a chart, let's say we go back to the earlier chart, like I think this one over here. In this case, right, when you see that the market is in an uptrend, we only want to look for buying opportunities. Why only buying opportunities? I mean, you can look for selling opportunities if you want to, but if you're a new trader just getting started, I recommend only to look for long setups, basically to look for buying opportunities, because that is the path of least resistance. Because when you look at markets which are in an uptrend, it is more often than not, right, that the market is likely to continue heading up higher. So by trading along the path of least resistance, by trading in the direction of the trend, you, number one, are putting the odds in your favor, and number two, you are getting the most bang for your buck. Because if you look at by trading in the direction of the trend, look how much higher the market can move in your favor. So by trading in the direction of the trend, the move can explode up this much higher. Whereas if you're like a counter trend trader looking for selling opportunities in an uptrend, you can see that the down move is much smaller, and much smaller. So this is why, as much as possible, you trade in the direction of the trend. So if you spot the market is in an uptrend, look for buying opportunities and avoid selling in that market scenario. A market is said to be in a downtrend when it forms a series of lower highs and lower lows. Something like this. Market hits down lower, pulls back, then breaks down lower, pulls back, breaks down lower, pulls back, break down lower. So if you look at the highs, right, you compare this high with this high. This is a lower high because this current high is below this high. And of course, this is a lower high as well. And this is a lower low because this low is below this low. And likewise, this is also a lower low. So you'll see a series of lower lows and lower highs in a downtrend. And just like an uptrend, right, when you see a market is in a downtrend, you want to look for selling opportunities because that's the path of least resistance. By looking for selling opportunities in a downtrend, you can see that the move, right, the magnitude of the move is much larger. You can see this is the magnitude of the move that you can expect, the magnitude of the move, the magnitude of the move. Compared to, let's say, you're looking to buy in a downtrend, the move is usually much smaller. You can see over here, this move is usually much smaller. Okay, so let's have a look at an example. So over here, this is the market, the pound against the dollar. And if you just identify the highs and lows, this is a lower, let's take this as the first high, then this would be the lower high, a lower high, a lower high, a lower high, a lower high. And then this is let's say we take this as the first low, then this will be the lower low, lower low, lower low, lower low, lower low. And a simple trick is that if you look from left to right, if the market is trending, it usually will point to one direction. In this case, it's just pointing down lower. And once again, right, when the market is in a downtrend, we want to look for selling opportunities. Now, some of you might be thinking, but Rainer, market downtrend is not as obvious, right? Sometimes I see the market spike up higher. I thought it's an uptrend. I buy only to get stopped out. Why? Well, that's because, remember, we have an idea to how a downtrend looks like, but the market somehow just doesn't, play out to our expectations. There are times where it can just do this. Market hits down lower, and then it suddenly makes a strong pullback, right? We thought this is the start of a new uptrend. We buy, only to see the market collapse down lower. So how do we not get caught, right, by this fake move, right? And again, we're going to use this principle which I just shared with you, right? Just that this time around is for a downtrend. A downtrend is invalidated only after the price breaks above the swing high that precedes the breakout, or breakdown if you want to call it. So let's say, for example, market is in a downtrend and then it breaks down lower, and then now it hits up higher over here. Okay, now where is the swing high that precedes the breakout? So the breakout point is actually over here. Okay, just look, it's over here. This is the breakout point. Okay, because it broke below this low, this is the breakout point. So where is the swing high that precedes the breakout? The swing high that precedes the breakout is actually this level over here. So until the price can break above this swing high, I would say that the downtrend is still intact until the market can break above that swing high. And if the market does break above the swing high, I would then tell myself, hey, this market could possibly go into a range or even start or be the start of a new uptrend. Okay, so let's have a look at a quick example. So quiz time, look at this chart. Let me ask you, is this the start of a new uptrend, or is the trend likely to continue down lower? So remember, the rule is this, right? For a downtrend is that a downtrend is only invalidated until the price can break above the swing high that precedes the breakout. Okay, so what do you think the answer is? So 1, 2, 3, 4, 5. Okay, so here's how I'll do it. So where is the price, or where did the price break out? So the breakout point is actually here. This is where the market broke out. And where is the swing high that precedes the breakout? The swing high is this one over here. So just to dive in a little bit more details, you can see that this is actually also a swing high. So how do we decide between this swing high and this swing high? So I like to be more conservative. I like to take the swing high that is actually higher, the one that is further away from the breakout point. So it's this one. So I'll reference this swing high over here. So until the market can break above this swing high, I would say that, you know, the market is still in a downtrend. Until, right, the market managed to, let's say, go up higher, break above this swing high, then I'll say at this point it could be the start of a new uptrend, or the market could enter a range. So in this case, you can see that the market did continue down lower because it did not break this swing high, this high that we've identified earlier, which is the key swing point in this downtrend. Yes? Now, what about range markets? A market is said to be in a range when it's contained between the highs and the lows. So let me give you an example. So let's say the price goes up higher, then pulls back lower, heads up higher, pulls back lower, heads up higher, and pulls back lower. So at this point, you notice that this market is not in an uptrend because it's, you know, it doesn't form a series of higher highs and higher lows. Neither is it in a downtrend because you don't see a series of lower lows and lower highs. Instead, what you have is actually a range market. The market is contained between this highs over here and this lows over here. Okay, so this is what we call support and resistance. This low of the range is usually what we call an area of support, and this highs over here is what we call an area of resistance. So this is what we call a range market. And of course, in reality, the range market isn't as precise as this, because in reality the market could break down below support and then goes back up into the range again. So let me give you an example of how a range market looks like. So you can see over here, this is an example of a range market. Notice how the highs and lows are not exactly precise. Notice how this at this price point over here, the market took out this low, so right, people thought it's going to be a breakdown before the market reverse up higher once again. But if you look at this from a macro perspective, you can identify that this market is pretty much a range market. How do we know that? Because look at the highs, right? There is the price retesting the highs multiple times, but, you know, fail to break out of it, right? This would be the highs to highlight, otherwise known as an area of resistance. And then this is an area of support, right? Price tried breaking below support as well, right? Tested once over here, twice, 3 times, 4 times, and then here a 5th time, right? Tried to, you know, hit down lower, but just couldn't break down lower. So you can see that the price is kind of like stuck between these highs and these lows, and it's what we call a range market. And of course, market doesn't stay in a range all the time, because eventually the market has to break out. And how do we know when the market has broke out of a range? When the range is invalidated is this. It's when the price breaks out of it, when the price breaks and closes out of the range. This is where we know that the range market condition is invalidated. So let me give you an example. So if you look at this chart over here, notice how this market is in a range contained between these highs and this lows over here, this area of support. And on this particular candle, we have a break and close right below it, right? So you can see that at this point, we can see that the market now has actually broke out below the range. The market is likely now moving into a downtrend, and at this point, this range market condition is invalidated.
Now you might be thinking, so Rainer, wait, how do we trade a range market? Do we just simply buy support or sell resistance? So for example, this is area of support, right? This is resistance. Do we just buy support and sell resistance? So for me, when I trade range market conditions, I don't just blindly buy support or sell resistance. I usually would want to trade from a level where I think the market is unlikely to break. So what do I mean by that? So for example, let's say in this example, if I think, right, I suspect that the market is likely to break below support over here. What I want to do is to sell at resistance, sell at the highs of resistance. So this way, if support does break down, you can see that my risk to reward, my profit potential on the trade is pretty great. And likewise, if I feel that the market is likely to break out higher, so for example, let's say in this case, the market is in this range, okay? Let's say if I feel that it's likely to break out higher over here, I don't want to be shorting at resistance. I don't want to be selling at resistance. Instead, what I want to do is to buy at support, right? To buy at this support in anticipation that if the market does break out higher, I have a pretty good attractive profit potential on this particular trade. So now how do I know which side of the market, or rather which side of the range is the market likely to break out so I don't get caught on the wrong side of the move? Good question. I'll share with you more details later on how I actually go about identifying such a scenario, or rather how I go about identifying which side of the range to play on. But for now, I want to do a quick recap first. Number one, uptrend. It's simply a series of higher highs and higher lows. We talked about that earlier. And uptrend invalidation occurs, right, when the price breaks below the swing low that precedes the breakout. If you don't understand what this statement means, rewind back this trading video for a few minutes and you can see what we talk about when the uptrend invalidation occurs. Then downtrend is just the opposite, a series of lower lows and lower highs. And downtrend invalidation occurs when the price breaks below the previous swing high that precedes the breakout. And then finally, we talk about the range, where the price is actually contained between the highs and the lows, contained between support and resistance. And finally, range invalidation occurs when the price breaks out of the range. Okay? And by the way, right, just because a market is in an uptrend, right, doesn't mean we immediately, right, hit the buy button. And likewise, just because the market, let's say, is in a downtrend, doesn't mean we immediately hit the sell button. Because for all you know, right, the market is trending and it could be like, overbought, really stretched to the limits and about to make a pullback. So if you buy when the market is kind of like overbought, stretched to the limits, that's when the market is, about to make a reversal and you get stopped out. So this is why we need to look at this second part of the strategy. Area of value. This helps you answer the question, right? Where to buy or sell. So where on the chart do you buy or sell? So area of value will help you with it. This is where you will also use the concept of support and resistance. So earlier we spoke about it, right? Support, if you recall, it is an area on your chart where buying pressure could, right? The keyword here is could, not definitely, but could step in to push the price higher. And resistance is an area on the chart where selling pressure could step in to push the price lower. So there's no guarantee the price will reverse at support. There's no guarantee the price will reverse at resistance. It's only could, maybe, might. So next question, how do you actually draw support and resistance on your chart? Well, here's how we do it. So first and foremost, right, this is example is a market which is in an uptrend. So if you know a market is in an uptrend, then you only want to identify area of support on the chart. And the way I do it is to identify areas, levels on the chart where the market bounce off higher. So you can see over here, this is one example, market make a pullback over here, bounce off higher. Made a pullback over here, bounce off higher. So what I'll do is I will draw area of support over here. There's one over here, and there's another one over here. Now, how do I kind of like fine tune my level? So the way I like to do it is that I like my area of support, right, to get as many touches as possible. So you can see that this black line over here that I've drawn, right, I can actually shift this black line up higher and take into account these lows over here. So that's what I'll do right now. So I'll adjust my area of support and push it up slightly higher. So this way, I got multiple touches. I got this one touch over here and two touch over here. So same for this over here, right? This one over here, I'll push this up slightly. Okay, so when I do this, I now got three touches. I got one touch, two, and three over here. And what about this one over here? I think there's another area of support over here. I'll draw this one here. You can see that if I were to draw here, right, I would either have to consider touching this line or push it down lower to touch this line over here. So again, what I usually do is that is either you're going to leave it at this line or you'll leave it at this line, because there's no way to get both of them being touched. So usually what I'll do is I'll take into account the more recent one and push it to somewhere here. Okay, and another tip to share with you is that support and resistance, they are an area on your chart, but I like to draw it as lines on the chart. This is my habit. So what if you want to do, you can also do is you can draw it as an area. Just use the rectangle tool on trading view over here. You can see rectangle, click on it, and you can just highlight it as an area on your chart. So again, you can change the color if you want to. This is gray. Okay, you can just draw this as an area on your chart. Then over here, you can draw it as an area on your chart as well. So this kind of like reminds you it's an area and not a line on your chart. So I'll remove this for now since I prefer lines, my own personally. And another thing to also share with you is that when you draw support and resistance, I typically have not more than 2 areas on my chart, because if you have too many, you're going to feel overwhelmed. You might be thinking, Rainer, what about this one over here, right? This is another level you can draw. What about this one over here? Another level that you can draw. And that's true, those are levels that you can possibly draw. But here's the thing, this will just clutter your chart with a lot of unnecessary information. And I usually just want to keep only the 2 most recent one. Why is that? So let me explain. So let's say, for example, why don't I have this particular level over here to leave it as support? Well, think about this. If the market comes down all the way to this level, at this area of support over here, the market reversed down lower, do I still want to be buying at this price point around 114.50? And the answer is no, even though it's an area of support. Why? And the answer is this, is because by then the market is no longer in an uptrend. Let me repeat, right? By then, if the market reaches this area of support, it's no longer in an uptrend. You can visualize the price action. At that point, the market is likely to be in a downtrend. And if the market is in a downtrend, I want to sell at resistance, not buy at support. So this is why I usually just have not more than 2 areas of support on my chart. So I'm just going to remove all the additional one. This remove, remove, and remove. So my support and resistance will look something like this on the chart. And also one more thing to add is that this level over here will be significant. Why is that? Why is this level significant? So recall about our uptrend invalidation. The uptrend will be invalidated right when the price breaks below the swing low that precedes the breakout. Yeah, so this over here is the swing low that precedes this breakout over here. So this high is the breakout point over here, and this is the swing low that precedes the breakout. So at this point, if the market comes down lower and breaks and let's say close below support, this market to me is no longer in an uptrend. It possibly could go into a range or even a downtrend altogether. So this is what I call the the last line of defense, if you want, the last line of defense where, support must hold. If not, right, the entire market structure will shift from an uptrend, right, to something else like a range or a downtrend. Now, another example, right, look at this chart over here. So let's do a quiz, right? Pause this video if you have to, right, and visualize, ask yourself, how will you draw resistance, right, in this downtrend? Where will you draw your area of resistance in this downtrend? So I will, do my version of it. You can pause this video and see, identify which levels you want to draw, and then we can compare and see whether your answers is similar to mine. And really, I want to say that there's really no right or wrong. This is just my own preference, my way of identifying resistance. If you have your own method that works for you, that's great. But if you're new, you have no idea where to start, then can try using my method first, right? And then from there, you can fine tune to what works for you. So for me, again, right, how I would do it is, again, I like to pay attention to the 2 most recent highs, the 2 most recent levels where the market actually declined from. So this is one I've identified over here, and then possibly another one over here. So notice how the market over here, it consolidates, right, then head down lower, then over here reaches this highs and then head down lower. So this will be the 2 area of resistance that I will draw on the chart. So I think I will leave this as it is, right? And again, why I don't have so many resistance area, why I don't have it here, why I don't have it here, again, is very simple. If you imagine this, right, imagine from where the price is right now, let's say the market rally up higher to these highs. Do you still want to be selling at this price point over here? Do you want to be selling here? Probably not, because this market is likely no longer in a downtrend. It's probably in an uptrend. And in an uptrend, as you've learned, right, you want to be looking to buy at support. So again, this is why I just typically have just the 2 most recent resistance on my chart, and that's pretty much it. So in this case, let's say if the market comes up to this area of resistance, this is where I can look for selling opportunities, right, to short this market. But of course, I don't just blindly, sell when the market comes to this price level. There's another thing I still look out for, which I'll share with you really shortly. But for now, this is how I would draw resistance in a downtrend. And finally, right, how do you actually draw support and resistance in a range market? So again, the concept is similar. You want to identify the levels, the areas on the chart, right, where the market has a huge swing, right, or huge decline or rally from it. So if you look at this chart, this is a key area because the market has a strong collapse from it. This is another one, right, another strong collapse. Now what about the lows, right? So this will be a key one as the market did rally up higher from it. This is another one, strong rally. This is another one, strong rally. So once you identify these key points where the market just keep getting rejected higher and where it keep getting rejected lower, this is an area on the chart where you want to pay attention. So in this case, right, recommend using a rectangle tool so you can better identify your support and resistance. And of course, if you want to use lines like me, it's your choice as well. So this would be my area of resistance, and for area of support will be somewhere about here. Okay, you can see try to get as many touches as possible. So you can see for this area of support, right, we have this 1 touch, 2, 3, 4, 5, 6, 7. This one over here, 1 touch, 2 touch. Okay, so actually this one here, I might even shift this up a little bit higher to take into consideration this lows as well. By the way, if you're enjoying this training so far, smash the thumbs up button. If not, hit subscribe so I can bribe you further with better content. So next one, right, entry trigger. So for this segment, right, this is where you look to answer the question, when exactly do you buy or sell? Because as you have learned, right, just because the market is at an area of value like support doesn't mean that you immediately want to hit the buy button, because you're still looking for an entry trigger to tell you, now is the time to enter the trade. So entry trigger is very simple, right? All the candlestick patterns that you've learned earlier, all the, the reversal candlestick patterns like the hammer, the shooting star, all those can be used as an entry trigger. So it could be things like your hammer, your shooting star, your bullish engulfing pattern, your bearish engulfing pattern, etc. All these are very useful patterns, right, that can serve as an entry trigger to get you into a trade. So for example, let's say market is in an uptrend, okay, you come back towards this area of support over here, and then over here you can look for an entry trigger, like in this case a hammer, which is a bullish reversal candlestick pattern, to signal to you that hey, now is the time to get long, so you can enter on the next candle open, right? So this is how an entry trigger works. So I'm not going to spend too much time and repeat what's a hammer, shooting star, etc., because you've learned all of that earlier already. So for now, I'm going to move on to the next section. Alright, so when it comes to exit, there are two questions, right, we are trying to answer over here. First one is this: exit when you're wrong. So where do you exit your trade if you're wrong, otherwise known as a stop loss? So when it comes to stop loss, right, I have a very simple principle. Your stop loss must be at a location, right, where if the price reaches it, it will invalidate your entire trading setup, your entire trading idea. Let me explain. So let's say, for example, you're looking to buy at support. Okay, price comes up, you buy at support, price up, it goes up higher over here. Where exactly do you set your stop loss? So a mistake that many traders make, right, pay attention, is that they simply set their stop loss somewhere here, or maybe somewhere here. Number 1 and number 2. And those are horrible places to set your stop loss. Why is that? That's because the market could easily just swing back down lower and then reverse up higher from there. So you can see if it does, like what I'm showing over you here, a false break, whether you set your stop loss at level 1 or level 2, you're going to get stopped out. So now how should you set a proper stop loss then? So this is what I recommend. When you set your stop loss, set it away from an area of value, or set it away from an area of value, away from price structure. So for example, again, go back to our support example. So let's say this is support, price bounce up, comes back down, bounce up higher. And this time, let's say you buy over here, let's call it E, or your entry. Your stop loss, right, you want to set it at a place somewhere about here, because at this point, right, let's say S over here is your stop loss. If the price, right, were to reach a stop loss over here at S, let me ask you, do you think that support, right, at this point in time is broken? And I think for most of you looking at this drawing, you say, yeah, support is broken. And yeah, since your basis of entering the trade is to buy at support, now support is broken, clearly you should get out of the trade. Exit the trade, because this is where the market has proven you wrong. So whenever you set your stop loss, you want to set it at a level, right, where the market will invalidate your trading setup. Let me share with you just one more example, right, because it's so important. So let's say you're looking to trade the bull flag pattern. For those of you who are not familiar, right, a bull flag pattern is where the market, let's say, breaks out, it forms like this out. This is what we call a bull flag pattern. And then let's say you breaks above the highs, you buy. So this is what we call a bull flag pattern. Now, at what price point, right, where if the market reaches that level, your bull flag pattern no longer looks like a bull flag pattern? I'll give you 3 scenarios: 0.1, 0.2, or 0.3. What do you think? I know this is a little bit of a trick question, and answer I'm actually looking for is actually more towards 0.3. Because if you look at 0.1 and 2, right, this low over here, right, is where buying pressure could come in. This is where potential previous resistance could become support. So if you set your stop loss at 1 or 2, the market can actually hit down lower, bounce into support, and then go up higher. And if you set your stop loss at level 1 or level 2, you'll probably get gotten stopped out of the trade. But if you set it at 3, this is where you're giving your trade more room to breathe, right? You're setting your stop loss away from this price structure, away from this area of value. And that kind of like, put the odds in your favor, because you're not going to get stopped out prematurely or too easily, yeah? So this is what we mean by exit when you're wrong, right? Setting a proper stop loss. Now, what about exit when you're right? Where do you take profit?
So there are different ways to do it. You can use like capture a swing, ride a trend and stuff like that. But for now, we keep things simple. We talk about capturing a swing. So let's say again, the market, let's say it's in a range, okay? Goes up, comes down, goes up, comes down. Let's say you buy at support, right? And where on this chart, right, might sellers come in? Where might sellers come in and push the price lower? And as you know, this is an area of resistance. This is where sellers might come in. So this means you want to set your target profit, right, just before this area of resistance. So maybe somewhere about here is a good level to set your take profit level, because if the price goes up, right, come into resistance, you take profit, great, right? Because what could happen is that the price comes into resistance and then quickly reverse down lower. So if you set your take profit level, let's say over here, you're making the market work hard for you. You're making the market, break out of resistance to reach your target. And if you were to make the market work hard for you, you will usually, pay the price. Yeah. So as much as possible, right, the market is the big boy, right? Follow the clues, right, that's being left behind by the market, right? Don't try to, push your luck, right? But rather respect the market, respect the price structure. If you know that this is an area where sellers might come in, right, then be conservative, right? Set your take profit level just before that area of resistance, and this will kind of like increase your odds of actually, exiting a trade with a profit. So these are two very simple guidelines, right, that you want to take into account, right, when setting your stop loss and target profit. So now I've shared with you the entire formula, right? If you realize it's what I call the May formula. A quick recap, this stands for number 1, market structure, area of value, entry trigger, and exits. Later on, which is about right now, I'm going to share with you examples, right? Trading examples, right, to see how this particular formula allows you to profit in bull and bear markets, right? Let's get to it. Congratulations, right? I know I've covered a lot, but if you've made it this far, trust me, you have now built a very solid foundation, right, to go out there to trade the markets, right, with clear, precise rules to know when to enter, when to exit, and how to manage your trades from start to finish. And if you ask me, you're probably ahead, right, of 90% of traders out there, because you have a clear plan, right, of what type of market conditions to trade, when to enter, when to exit, etc. But before we move on, right, into the trading strategy examples, I want to walk you through what we have just talked about so you don't forget, right? So number 1, we spoke about the market structure to know whether the market is in an uptrend, a downtrend, or range. We talk about if the market is in an uptrend, we don't want to look for buying opportunities. If the market is in a downtrend, we want to look for selling opportunities. And if the market is in a range, right, I usually like to play on one side of the range, right? And it's usually the side of the range where I think the market is unlikely to break out of, right? And I'll share with you later how to choose the right side of the range to trade from later on. Next one is an area of value. You've learned things like support and resistance, how to draw support, how to draw resistance in different market conditions. You've learned entry triggers, right? Things like candlestick patterns, the hammer, the shooting star. We covered a lot of that, right, earlier in today's trading. And finally, we talk about exits, right? Where to protect your downside, where to cut your loss if you're wrong, and where to take profits if the market does move in your favor. Now, the next section is going to be important because this is where we take the concepts, the techniques, the strategies, everything, right, and apply it to the charts so you can see how everything come together. So let's go. Okay, this first example is the chart of Swiss franc against the Japanese yen, the daily time frame. So first thing is the trend. Let me ask you, what is the trend? Is it up or down? You can see the market is in an uptrend. Good. Next one, where is the area of value? Okay, you can pause this video and visually identify the area of value, but for me, here's where I'll draw it. Over here is one, and possibly another one over here. Okay, these are the two area of value on my chart, right? So did I plot this two level? Because this is previous resistance, price breakout, retest as support. Previous resistance, price breakout, retest as support. So now price could possibly come back to this area of value or this one over here. Now, why don't I draw area of value, let's say over here or maybe over here? Well, because at this level and this level, I don't want to be buying at that price point because if the market do reach that level, the market is probably already in a downtrend. I don't want to buy in a downtrend. I only want to look for selling opportunities in a downtrend. So no point drawing those two levels because if the price do get to it, the trend would have already reversed and I'm no longer looking for buying opportunities. So now that we have spot, right, these are two area of value, the two blue box over here. Next thing, we are looking for a valid entry trigger to go long. As you know, you've learned things like your hammer, your bullish engulfing pattern. So let's see what happens next. So in this case, the market came into our area of value, but do we have an entry trigger to go long? Let's find out. Yep, we have it, right? The market formed a hammer and this tells us that, hey, the buyers are now temporarily in control. So if you understand the story behind this, you can see that the market overall is in an uptrend. The market make a pullback towards this area of value. In area of value is where buying pressures could step in and push the price higher. And you got clues, right, that buyers are stepping in because the market opened over here, tried to break down lower, couldn't, but reversed eventually and closed near the highs of the day. So this tells you that buyers are stepping in. So what you can do is to
go long, right, on the next candle open. So let's say next candle open over here, right? This will be our entry price, right? The opening price. So let's just say we change this to green to signify our entry. What about stop loss? So for stop loss, right, I like to, if you remember, right, we like to set it a distance away from price structure, a point where it will invalidate our trading setup. So you can see that this is an area of support. So if the price breaks below this area of support, we want to be out of the trade. So at which exact price point, right, do we know we want to get out of the trade? So one way to kind of like quantify that answer is to actually use the ATR indicator, right? So I'll just show you average true range. Click on this. Okay, I'll just delete this one. I'll use this one, right? The settings I use is 20 period. There are 20 period and SMA. You click OK. So what you'll do is to find out what is the ATR value. Okay, so you can see that right now the ATR value is 1.221. What this tells you is that over the last 20 trading days, right, the market moves an average of $1.221 dollars per day. Okay, and the way to kind of like know where exactly to set your stop loss is to find out the low of this candle and minus 1.221. So the low of this candle, right, is actually, let me just bring my cursor here, is 137.15. Okay, so 137.15. So I'll just take 137.15. This is the low over here. And I minus off with one ATR, which is 1.221. And what does it give me? I'm just going to pull out my trusty calculator and I get 0.221. I'm just going to round up to make things easier. 135.93. Okay, so this will be my stop loss level. So what I'm going to do is to bring out this line over here. I'll just change this to red to signify stop loss, and it's at 135.93. Okay, and there you have it. This is my stop loss level. And if you recall, what about target? Where do we want to exit if the market moves in our favor? So usually I like to set my target just before, right, the recent swing high, just before resistance. And from what I'm seeing on the chart, right, this is an area where sellers might come in to push the price lower. So just put this, let's just change this to blue and to signify our target profit. So now for those of you who want to, be a little bit more, or rather want to know what is your risk to reward on the trade, you can actually use this tool. Just click on this long position. Since you're looking at a long trade, click on this, and green is your entry price. I just press the tool on over here, shift this one over here to your stop loss level, which is the red one, and this top one over here, which is the blue one, which is your target, and it'll tell you what is your potential risk to reward on this particular trade. So I'm just going to adjust it slightly to be a bit more accurate. Okay, so you can see that your potential risk to reward on this trade is 1.13 as shown over here. This means that you're risking $1 to potentially make $1.13. And since this is a cherry pick chart, all right, you can see that the market eventually did reach our target over here, and you have exited with a profit. Now let's have a look at another example, shall we? So again, the May formula. I'll just do a quick recap here in case some of you have short-term memory like me. MAEE, right? May one. Ask you, what is the market structure that you're seeing on this chart over here? This is the New Zealand Canadian, the 4-hour time frame. What is the market structure? The market is in a downtrend, right? Great, right? Market is in a downtrend. So you know that the market is in a downtrend, then where will you look, right, to trade from? Where is the area of value that you want to pay attention to? In this case, area of value is at resistance. Fantastic, right? So let's cover this first too. So you know market is in a downtrend. Area of value, I'll probably highlight this one over here. Okay, that's probably the key one that I'll pay attention to. And let me just change this to black, right, so we don't get confused later on with our entries and exit. Okay, and again, for those of you who prefer to have it drawn as a rectangle, you probably look something like this, right, as an area on your chart, right? That's perfectly fine. So all that's left to do, or rather the next thing to do, is to wait for the market to come towards your area of value, or in this case, resistance. So you can see the market head up into resistance, okay, breaks into resistance at this point, and this candle over here, we have a valid entry trigger. This is what we actually call a bearish engulfing pattern. The story behind it is similar to a shooting star pattern, right, where the buyers were initially in control, and then they quickly, right, got disrupted, and the market got pushed down lower by the seller, closing below resistance. Also, actually, you can see it's actually a false break as well. The market actually took out this highs and quickly reversed back into below resistance. This looks like number one, but anyway, yeah, so this is a valid entry trigger to go long, telling you that the sellers are in control. So what you can do is, again, to enter on the next candle open. So again, next candle open at this price point, let's put this as green, right, to signify that is our entry point. Okay,
I notice there's quite a few black lines over here. I'm going to remove some of them so you can see better. Okay, now what about our stop loss? So in this case, again, you can pull out the ATR indicator, the average true range indicator. I'll just do this one more time. So what we are trying to do over here is to set our stop loss a distance away from resistance because we don't want to get stopped out prematurely. So what you'll do is, again, find out what is the high over here and add on, right, by this number of ATR value. In this case is about 45 pips. So let's do a quick calculation. The high of this candle currently, it shows that it's about let's see, 7885. Okay, so 7885 you plus 45 pips, right? That gives you 7930. So your stop loss will be placed at 0.7930. So I'll change this to rate, okay, and 0.7930. Got it. Okay, so that is your stop loss level, right? This over here is your stop loss. So basically how you interpret that stop loss level is that from this high, you add on 1 ATR. Okay, you add on 1 ATR is equals to this level that you're seeing on the chart over here. Next thing, right, where is your target? So if you look at target, right, there are two levels that showing up over here. One is this recent swing low, and this one is a more of an extreme, further away, right, that swing low. So in this case, usually I like to have first a conservative target over here. So in this case, you can actually have your trade, right, all exit at this swing low. That's a perfectly, valid thought process. Okay, but at the same time, right, let me just remove the indicator. At the same time, right, some of you might be thinking, but Rainer, if you look at this market, right, if you look back, this market is actually in a downtrend, Rainer, and the price tends to break below this low, break below this low, break below this low, because you look at this, the price over here, it breaks below this low, and then it makes a pullback. So won't we, be giving up some potential profits because we can still look to capture this additional bit of the move, right, as the market breaks down lower, right? So that's a fair thought, right? So actually what you can do in this case is actually to have two targets. One is a more conservative target and one is a further target. So let me share with you how to do this. So in this case, your first target can be over here. Okay, this is your first target. Let me just change this to blue. Let's call this target 1, right, TP1. Okay, and you can have a second further target, right? As you know, the market is in a downtrend. It could break below the lows and go a little bit further. So in this case, this is the extreme low over here. For all you know, this market could possibly, break below this extreme low, right? And then make a pullback. So you want to kind of take your profits, right, somewhere about here, right, where you can get the most bang for your buck. So how do you do this, right? So how can you do this objectively? So what you can do is you can use a tool, right, called a Fibonacci extension, right, and look to exit, right, at just before the 127 extension. So I'll just get out, show you what I mean. Look at trend-based Fib extension. Click on this. You draw it from the swing high to the swing low and back up high again. So this is the swing high down to this extreme low and then up higher again. Okay, so once you do that, you can see that over here. Can't see it over here. There, over here. I'll just manipulate this chart a little bit. Okay, you can see over here. I want you to pay attention to this level over here. This is what we call the 127 extension, and over here is an objective way where you can look to set your second target. So I'll just draw a second blue line over here just before the 127 extension, maybe somewhere about here. Okay, so let's see what happens next, right? So in this case, right, I'll just remove the Fib extension since it looks a bit messy, but at least you know how this second blue line come about. We actually use the Fibonacci extension to kind of project, right, where the price could go, right? So we can just take advantage of that extra little pips, right, as the market break down lower. So what I mean by this is that, example, this is a swing low. Market break this swing low by quite a little bit before it makes a pullback. So the question is, where exactly, right, do you take profits, right, as the market breaks down lower? So this Fibonacci extension gives you that a little bit of objectivity to it. Okay, so I'm just going to remove this Fib extension first and see what happens. So in this case, the market, you can see that it pretty much went lower over here and hit our first target relatively quickly. So at this point, market continued down lower over here, almost reaching our target here, and didn't quite. And now it's making a pullback. And as you can see, this is how the market is right now. So at this point in time, right, so what you can do is actually, your stops is already in place, your first target is already taken, and your stop loss is already at a logical level. It's still over here. So what you can do is, again, leave your stop loss as it is, right, and let the market either, hit this second target or hit your stop loss, right, because there's really no point, trying to shift your stop loss, right, to break even, because again, there's a good chance you could get your stop loss hit at break even. So what many traders like to do in this case is that they set their stop loss to, let's say, break even. They bring their stop loss down to their entry point. But to me, that's not really very logical, because there is no kind of barrier, right? Because this is an area of resistance. If the market comes up higher and then hits down lower,
you can see that in this case, right, you will get stopped out on your trade, right, on the second half of the position, and the market eventually hits your target and you're not in it because, you give in to your fear. So usually what I do is that, my stop loss is already at a logical level. I'll leave it as it is. My target is at this point over here. I know I almost got filled on the trade, but I didn't quite, so I'm just going to leave my plan as it is. Either it's going to hit my stop loss or hit my target. I already taken partial profits on this first target over here, so even if the second position hit my stop loss, hey, guess what? This overall trade will not really be a loser. It's probably could be more of a break-even trade or a very, very tiny loss. So at least that's my thought process to how I would, go about handling this trade.
Alrighty, so in this example, right, I want to share with you an example about the range market. So if you look at this one, at this point in time, this chart, the market might seem to be in a range. And earlier, if you recall, at the earlier part of this training, I mentioned that when the market is in a range, I still tend to have a directional bias. Sometimes I want to be buying only at support, or sometimes only to sell at resistance. So now the question is, how do I decide when the market is in a range? Do we buy at support or sell at resistance? That's what we're going to cover right now. So if you look at this market at this point in time, right, what I want you to do is actually to go up to a higher time frame and see what the market is doing. So if this is the 8-hour time frame, I'm going up to the daily time frame. And as you can see over here, the daily time frame, this market is actually in a long-term uptrend. This means, right, on the lower time frame, if the market is in a range, as much as possible, I want to be a buyer. I want to buy at support because I know that the market is in a long-term uptrend. And because you're buying at support and the market is in a long-term uptrend, the chance of the market breaking out of resistance is higher. Okay, so let's get back to the charts, right? So this is the 8-hour time frame chart that I was sharing earlier. So again, the same thing applies, right? So market is in a range. We look to identify the area of support that we want to trade from. That's the area of value. So I'm just going to draw this horizontal line somewhere about here. Change this to blue to signify support, shall we? Next thing is to wait for the price to come into support. So let's see. So in this case, the market has come into support. Great. Next candle over here, right? It has break below support. At this point in time, many traders will think, oh man, Rainer, support is going to break down, right? Let's short this market. Okay. Then what we see next happen is that the market then show signs of reversal, and this is what we call actually a false break. It's a valid false break as the price took out below these lows and then quickly reverse and close back above support. At the same time, right, traders who are familiar with candlestick patterns, they might call this a bullish engulfing pattern. That's fair enough as well, because as you can see, right, the candle has actually engulfed, right, the prior candle. So this is the prior candle. This green candle has actually covered the body of this prior candle over here, the red one. So this is what we call a bullish engulfing pattern. So of course, needless to say, what we can do is actually go long on the next candle open. So let's see what happens next candle. You can see that this is the opening price. Let's set this as our entry, right? So let's change this to green. This is our entry. Stop loss, I'm not going to do the 1 ATR calculation because you should be familiar by now, but your stop loss, I would say, somewhere about here. Okay, let's change this to red. There you have it. Okay, this black line, I'm just going to remove it. Since you know this is an area of support, I remove it. So what about target? So you know that the higher time frame, the market is in an uptrend. So how can you, take advantage of it? So again, you can use similar principles that you've learned earlier. For example, if you want to exit your trade before opposing pressure steps in. So I would say this is a good level to reference to, right? Because this is where sellers could come in, right? So over here, let's put this as our target. Just before this area of resistance over here. Okay, so just before this area of resistance, we look to take some profits off the table. And as you've seen, right, earlier you've learned a technique where we use a Fibonacci extension, right, to kind of like project where the move might end. Okay, so of course you can use Fibonacci projection for your second target, but another technique I want to share with you is what we call trailing your stop loss. This is very useful because as you've seen, right, on the daily time frame, this market is in an uptrend. So imagine this. Imagine that the market breaks out of this highs. It breaks out of this highs and then continues up higher. You can imagine that there's a lot of profit potential towards the upside. So how can we capture this trend? So what you can do is to use a trailing stop loss. So there are many ways to trail your stop loss. Okay, let's go back to the 8-hour time frame again. There are many ways to trail your stop loss, but one approach you can use is moving average. But for now, let's see what happens in this on this time frame. So you can see that market starts to show signs of headache, about to hit higher. All right, so this one you can see market quickly hit our first target over here. Okay, at this point in time, right, your first target is met, right? And let's say you have, you sell half your position, right, at this first target. So you have the remaining half of your position still on. So how can you manage the trade on the remaining half of your position? So let's say, for example, right, let's just, for simplicity's sake, let's say you buy 10,000 units of dollar against the Chinese yuan. You sell over here 5,000 units, right? So at 5,000 units at this highs over here. So you take profits. So what's left over here now is you have the remaining 5,000 units on this currency pair, dollar against the Chinese yuan. How can you manage this trade on the remaining 5,000 units that you are long? So what you can do is to trail your stop loss. You can use something like the 50 period moving average. So for example, you just go to moving average. Okay, this one comes up. Typically, if you want to trail your stop loss, I recommend, I won't say recommend, but if you want to ride medium-term trend, right, you can use a 50 period moving average and click OK. Okay, so what you can see over here on this chart is this blue line over here. This is the 50 period moving average that I've inserted on the chart. So the way to trail a stop loss is that you will hold the remaining position that you have until the market breaks and close, right? Breaks and close below this 50 period moving average, below this blue line. And of course, if the market continues up higher, that 50 period moving average will continue up higher along with it. So let's see what happens. So in this case, right, you can see the market breaks out higher. I'm just going to play this a little faster. Right, you can see that as the market goes up higher, your trailing stop loss, your 50 period moving average is going up higher as well. So in other words, you're kind of like locking in your profits as the market progressively move in your favor. And you will exit the trade only when the market breaks and close below the 50 period moving average. So in this case, you can see the market continues up higher. Okay, almost right, breaking and closing below the 50 period moving average, but it didn't. So we continue to hold, right, the remaining 5,000 units that we have on dollar against the Chinese yuan until the price breaks and closes below it. So it's still grinding up higher, as you can see. Okay, and then over here, finally, it has now finally break and close below the 50 period moving average. And this is where we exit the final portion, or the second half of our portion, right, of our trade. Okay, so you can see that this, if you write this trend up higher, you can see that this profit potential on this trade is going to be pretty attractive. This was your initial risk at the start, right? You can see this was your initial risk, and then look how much higher the market pretty much exploded to this point over here. So I would say, in terms of risk to reward, I think possibly risking $1, you know, to make maybe $4 or $5 or so. Okay, so that's pretty much it for this example, and let's move on to the next one. Now, let me share with you an advanced strategy, right, using the concepts that you've learned earlier. So this advanced strategy will help you identify low-risk trading opportunities, but at the same time offer you a more favorable risk to reward on your trade. So this means you can possibly, risk $1 to make $4 or more. So here's how it works, right? So first thing first, again, what is the trend in this market condition? So you can see this market is in a downtrend. Downtrend, we look for selling opportunities. So where is the area of value on the chart? So in this case, the area of value is what I'm seeing over here. I will draw it somewhere about here. This is the area of value that I'm looking at. So if you recall, right, earlier, the basic strategy is where you look for a price rejection or a reversal candlestick pattern at this area of value. But to take things a step further, this advanced strategy, you can actually go down to a lower time frame, right, to fine tune your entry. By doing that, right, your stop loss, right, is smaller, it's tighter, and this means that you get a more favorable risk to reward on the trade. So in this case, let's go down to the 8-hour time frame. So the 8-hour time frame, this is the area of value that I've highlighted earlier, the same one. What we're looking for now is, again, the same thing. Price rejection at this high. So we are looking for the price to come up higher and give us a bearish price rejection. Could be something like a shooting star pattern. And then from here, we will enter our trade. So imagine this, right? If you're entering on an 8-hour time frame, you're going to be much earlier compared to someone on the daily time frame. And when you're trading on an 8-hour time frame, your stop loss is going to be tighter, smaller, because the range movements of this market on this time frame is smaller compared to the range movement on a daily time frame. I mean, it's logical, right? The price movement on a 5 minutes time frame is much smaller compared to a weekly time frame. So same thing, the 8-hour time frame, the price movement is going to be smaller compared to the daily time frame. So let's see what happens next. So in this case, market tried to rally up higher, okay? And over here, we have a bearish price rejection looking something like a shooting star pattern. So what we can do is to go short on the next candle open, right? So let's say we go this one over here. Let's say our entry price is over here. I'll just change this to green to signify the entry price. Okay. I'm not going to do the, I'll just remove this box. It's quite irritating. So I'm not going to do the ATR calculation for stop loss because you already know how to do it, right? So I'll just, in Singapore lingo, we call it aga-aga. We just estimate, right? So I'll estimate the stop loss, the 1 ATR stop loss to be about here. Okay, so, and by the way, right, when you set your 1 ATR stop loss, right, the ATR value will be based on the 8-hour time frame. You can reference the daily time frame if you want, right? But I usually use the 8-hour time frame, so I get a nice tight stop loss. And as for target, you can see that over here we have a few levels, right, where buyers might step in and to push the price higher. So the first one, I'll say this is one possible area worth paying attention to. I'll put this to blue, okay? And since, right, this is the first, this is our target, right? And since, right, you've seen that on the daily time frame,
this market is in a downtrend, there's actually a good possibility that this market could also retest this low over here. So for target, I would also have another target, right, just before this area or swing low. Okay, so if you go back to the 8-hour time frame, it looks something like this. So at this point, now we have multiple targets, right? This green is our entry, this red is our stop loss, and this blue here, we call it TP1, our first target, and this one is our second target. Okay, so in this case, that you can see that instead of using the daily time frame to fine tune your to enter your trade, you're now using a lower time frame to enter your trades earlier, and thereby improving your overall risk to reward on the trade. So in this case, right, again, admit this is a cherry pick chart, and you can see that price, right, would have hit your first target over here, and let's say once the price has hit your first target, there are times where it just simply starts to move against you and then hit your stop loss. And if it does happen, right, don't worry, because this will probably just be a break-even trade. Because imagine if you short, let's say, one lot, right, of this market, you would exit 0.5 lot at this first target, profit in the bag. And your remaining 0.5 lot, let's say the market reaches your stop loss over here, right? So 0.5 lot, this one over here is a loss, this one here is a target. So overall, this trade will probably be a small profit or a break even. Yeah, so that's kind of like a how multiple targets work. So we can see that in this case, the market did eventually hit down lower and hit our second target as well. So overall, I mean, as I've said, it's a cherry pick chart. This trade would have worked pretty beautifully in your favor. But bear in mind, right, there are times where the market could also reverse against you, hit your stop loss, and that's the reality of trading.
Okay, so moving on, right? If you're enjoying this training so far, smash the thumbs up button. If not, hit subscribe. So moving on, right, let's do a super quick recap about the May formula. So again, May stands for market structure. A is area of value, E is for your entry trigger, and the other E is for your exits. Exits where you're right and exits where you're wrong. So if you look at this chart over here, this is the chart of gold, the daily time frame. What is the market structure? Market structure is in an uptrend. So we are looking for buying opportunities. Where is the area of value? So from what I'm seeing over here, I would say this is a possible area of value. So this area of value, I would say, is a little bit tricky in the sense that I see one over here, and I possibly would see, let me just change this to black first. Okay, and I possibly see slightly lower another one over here. So you can see that this area of value is pretty wide, right? You have no idea whether it's going to retest this level or this level. And if you draw this like an area, it's going to be a pretty wide area. How do you kind of set your stop loss when the area is so wide? How do you know when to enter? So what I like to do in this case is to let the market give me clues, right, to where it's about to show signs of reversal. So what I like to do is to let the market usually come down first, make a first test and bounce, and then come down again, make the second test giving me like a false break, and then bounce up higher. So at this point in time, I roughly know that, okay, buyers are coming in around this area. I will reference this level, right, to kind of set a proper stop loss. Okay, so let's see what happens next. So I'll just let the market continue, right, heading down lower. At this point, we have like a hammer. Okay, so at this point, I wouldn't want to buy over here because, again, the market could at this point go up, right, and come down and continue the downtrend. That could happen. So I would want to see the market make another step lower and fail to go down lower, right? And that at that point in time, that's where I would want to time my entry to go long. Okay, so but what we have over here is that the market has come into our area of value. Let's see what happens. Market heads up higher. Now consolidating a little bit. And then heading up higher. Nice. Now it got rejected a second time. So again, pay attention to this one over here. The market head up higher, swing down lower, taking out these lows. And then on this most recent candle, notice the price rejection. The market tried to break down lower, couldn't, and close almost near the highs of the days over here. So at this point, when I see this, right, I want to go long because the market has tell me that it tried to push the price down lower 2 times and failed. So that to me is a signal that, okay, buyers are possibly coming in from this area of value and could push the price up higher. So what I'll do is, again, I'll look to enter on the next candle open. So let's see the next candle open over here. I'll look to go long. Okay, I'll just put this in green, signaling my entry price. I'll remove the 2 black lines since this is the area of value. I'll set my stop loss at 1 ATR from this most recent extreme low, which is this one here. So probably my stop loss is somewhere here. Okay, just change this to red. Okay. As for target, I will set it just before this most recent extreme high over here. Okay, pretty decent risk to reward. So set it over here. Okay, somewhere about here. I'll change this to blue. Okay. Some of you might be thinking, but Rainer, why not this level over here? I would say this one here is fine. It's okay, to be honest, right? Because although your risk to reward is slightly less than 1, probably 1 to 0.8, I think that's a decent level to actually set it as well. So let's set our first target just before this extreme swing, not extreme, but this most recent swing high, okay? And a second one further away over here. So 1, and then the second one over here. Okay, let's see what happens next. So in this case, the market pretty much reach our first target relatively quickly, but this is not a big winner because you're probably like risking $1 over here, right? As you can see, this is your risk. This is your risk. Okay, and this is your reward, right, to the first target. So I think you're probably risking like maybe $1 to make 70 cents, 60 cents or so, right? But because you have a second target, overall this trade could still be a profitable trade, right, if it reaches your second target. So first target is met. Let's see what happens next. So in this case, the market now showing signs of reversal, going back to your entry, putting you in the red right now. So again, remember, many traders, they'll panic. Let me cut my loss, let's move on, right? No, remember, your stop loss is already at a place, right, where it's logical. It's away from the noise of the market. It's away from support, right? Now support is not even broken. Support is now still intact. You don't want to be cutting your loss, right, into support, right? So your stop loss is there for a reason. Adhere to your stop loss. Let the market do what it needs to do. And in this case, you can see over here, market starts to again go up and down, right, messing with your emotions and feelings, and then finally you got stopped out on this trade over here. So this trade overall, I would say it will be a loser because your first target probably is not enough, right? Your first target here is probably not enough to cover the loss on this second half of your position, and it's perfectly fine. Where I'm going over here is to kind of like let you know that, when you trade as a trader, you will have winners, you will have losers along the way. I want to be honest about this upfront. The May formula is not the holy grail. Okay, so manage your expectations. Hopefully by sharing losers with you, right, you would actually go out there to trade the markets, hopefully on the demo or a really small account, and to manage your expectations to know that there will be losers, plenty of losers, right, that will come your way.
So, congratulations to making it to the end of today's training. And if you've enjoyed it so far, then here's what you'll love, right? You will love, right, this guide over here called the Monster Guide to Candlestick Patterns, where we talk about additional tips, tricks, and strategies not covered in today's training. So if you want to grab a copy, just go down to this website, tradingwithrainer.com, or I'll put the link somewhere below this video for you to click on. And then go to this website and click on this orange button over here. I'll send you a PDF copy of this guide for free. So with that said, right, I wish you good luck, good trading. I will talk to you soon.